Welcome back to Capital Conversations. Today, I am thrilled to welcome Arlett Tygesen. Arlett has nearly 2 decades in capital markets. She co-managed over $2.5 billion in a private equity portfolio at OMERS, one of Canada's largest pension funds. She later transitioned to capital raising at JP Morgan and served as the inaugural executive director of the Institutional Limited Partners Association, representing over $2 trillion, with a T, trillion dollars in assets. Now, as the co-founder of Titan REI Co., Arlett channels her expertise into U.S. multifamily real estate, focusing on capital raising, investor education, and operations in the multifamily space. She's also making waves on social media. I mean, I've seen her Instagram. It's awesome. She educates people on personal finance. She demystifies investment strategies for a broader audience. So excited to bring her on. Arlett, welcome to the show.
Hi, AJ. How are you? Thanks for having me.
Absolutely. No, thanks for coming on. And I'd love to just kind of dive right in, right? Your career genesis right at the beginning. Can you walk us through your journey from Bay Street to now Main Street in the US? What drew you to private equity initially?
Yeah. Well, can I start a little bit earlier than that? I was teaching skiing when I was 16 years old, and one of my students' dads was an investment banker, and I didn't even know what that was. I grew up in a family of all creatives, art dealers, artists, everything artistic, and someone hired me to teach their daughter how to ski. So he liked my process. He liked how informed I was, how thorough I was, and he offered me a summer job to work at his investment bank. It was a very small boutique, and that's how I got my feet wet in finance. And I had no plans to ever be in finance. I didn't even know what it was really. And then it just set off a whole new course for me. So I started out in public markets. In fact, I was a public markets analyst in oil and gas, steels and aerospace, all those sexy sectors. And then I moved over to the pension fund and became an analyst over at the pension fund. And there were four of us. We co-managed $76 billion at that time across the sort of four quarters there. And then they were starting up this really cool, interesting sounding thing called a private equity funds. It was restarting, actually. They had it years before. And they were restarting this $2.5 billion private equity portfolio to be co-managed by two people. So I jumped at that because I love anything that's kind of really interesting or pioneering or the first of something. I always love those kinds of opportunities. So I jumped at it, and it started me out on this whole career path that I could never have predicted. So it was pretty interesting.
So you managed, you said, over $70 billion. Was that at OMERS?
I was at OMERS across four analysts. Yeah. 76
Nice.
at the time.
Nice. So no small feat. What were the key challenges and learnings from that experience?
Oh boy, lots of them. That was capital markets, so everything was publicly traded, and you had to stay on top of your sectors. Every day we had to provide reports to our boss to say like what positions we thought we should be buying, selling, holding, that sort of thing. We had to it was a very, very in the moment kind of staying aware of deals that were happening or transactions happening in the market. What an oil and gas company was doing, what transactions were happening, that type of thing. Private equity is a lot more long-term view of things. So I liked that pace a little differently. I really loved capital markets. It was a lot of fun, but private equity allows you to kind of sit back, do some real deep research. And it was just a different kind of opportunity. Plus, again, the pioneering thing was super cool to me.
And tell me about JP Morgan. That's a little bit of a different shift, right? I would assume that's more institutional. It's something that's a little more established. How did that role evolve?
Yeah. So everything I did was institutional. So when I started in capital markets, that was institutional investing, institutional equity research. I moved over to JP Morgan near the end of my capital markets career before I started my own real estate firm. And I had kind of gone from being a limited partner investor at the pension fund. Then I became the first executive director of the ILPA, which was 200 members of, large public pension funds all the way down to small family offices globally. So we had 200 members around the world at that time, $2 trillion in assets under management. We focused on standards and practices. So what was what was the rule book for limited partners and general partners to conduct business. Because before that, it was the wild, wild west. There was no standard, deal terms like waterfalls, fees, anything like that. The GPs, depending on how popular they were, they could charge whatever they wanted. So we sort of put our weight behind as, large check writers. We sort of said this needs to be a bit more standardized. So we were effective in writing sort of the first playbook on GP-LP relations, best practices, policies, and procedures. It was pretty cool, again, pioneering, to be involved in that kind of thing. It really set a whole standard in an industry that, was fairly loose, I guess, at the time. And we're talking like the 80s and 90s, right? And then from there, I moved into capital raising. So I started out with a small boutique firm. Then I moved on to Bear Stearns. I really wanted to work in New York, and I was really excited to be able to move to New York. I didn't actually move to New York. I commuted to New York for many years, reverse commuting. I lived in Toronto, lived in New York. And then Bear Stearns went up in flames, as we all know, in the 2008 crisis. And JP Morgan bought our group out of the crisis, thankfully. And it was such an amazing pivot for us and a very different culture. Bear Stearns had a very specific kind of culture. JP Morgan had a different kind of culture. I loved all of it. Then, then I decided from there I wanted to start my own firm, and thought we were going to build a really big business in it called Quartile One. And it was going to be the first LP-driven data analytics company. So it was a quantitative analysis and benchmarking strategy. And we were going to harness the LP metrics for the first time ever. And the challenge with that is, as an LP, you sign a confidentiality agreement every time you do a deal. So the permission to be able to release that data was challenging. We started getting a lot of fund-to-funds signing up because we had some wiggle room around that, but it was a bit challenging. So, and at that point, another opportunity came about. So I sort of pivoted from there. But had we stuck the course, AJ, a competitor recently announced, I shall not name, recently announced that they sold themselves for $3 billion. So if we had the right idea, but this was many years ago. So, and then I moved into, I set up my own real estate investment firm a couple of years ago, and now I'm doing it all for myself.
Nice. Yeah. And we're going to deep dive. Don't worry. We're going to deep dive into the real estate side, but I want to stick on the private equity side for a little bit.
Sure.
You had some really interesting experiences between Bear Stearns, JP Morgan, OMERS. And now you're able to take some of the culture tidbits from each of those and implement them into your own thing. So what would you say are some of the things that maybe you pulled from each of those that you've now conglomerated into your own? What were your favorite parts of each culture?
That's a good question. I think I really underestimated the value of the institutional caliber of management and operations that you could apply to what is arguably a retail space that I operate in now, right? So my clients are not institutions. They are small family offices, individual investors, so it's taking the level of or caliber of due diligence, operations, management, just education in general, and applying that to the retail space. I think that lifts, in my mind, this is what my goal is, it lifts the caliber of how you do deals, how you communicate with your investors, how you conduct your business, how you underwrite a deal. There's just levels of professionalism that we can apply, because my partners and I, we all have this sort of corporate level or institutional level of experience in terms of how to underwrite deals or find deals even, and how we actually educate our investors and bring them along for the ride. And, for us, transparency in communications, all that is really, really high caliber for us. And I think it is for any GP that is really professional nowadays. And you're going to see it more and more, where the ones that are super professional are maintaining their level of communication with their limited partners right now in times of chaos, because with the markets falling apart the way they have been, and there's no cash flows, no distributions, the poorly managed partnerships are the GPs that have gone completely quiet, and the LPs aren't hearing from them. And I think they're just doing such a disservice to their limited partners, because that's who you're serving. This business is really about serving your investors, and the returns come because you're serving well and properly. You're not going to, maintain your reputation, or your investors aren't going to come back to you if you're not serving them, right? So it's serving first, that builds trust, and the returns come.
Yeah, you spoke about the Wild West a little bit earlier, and I think that's a similar example. There's in some ways, there's a really low barrier to entry in certain aspects of real estate.
Mhm.
And I think because of that, part of it became a little bit of a Wild West. And now we're seeing some of the fallout from that. So I think that's a great call out. The folks that are very successful and very professional are the ones that are continuing to communicate, even if the market's not cooperating with their
Mhm.
initial pro forma, they're
Mhm.
still communicating with their investors because, like you said, that's who they're there to serve.
Absolutely. It all comes back to the practices and policies you've put in place from day one. You know, your newsletter, your quarterly financial reports, your occasional webinars. It's making sure that you are consistent in good times and in bad.
Right. So let's shift a little bit from the private equity side to now real estate investing, because that's a little bit the direction that we're heading in, right? So what inspired your transition from PE to now real estate?
Well, that's a good question. I thought about this a lot. It was really just I had an aha moment one day. I've been thinking about pivoting. I took a couple years off to raise my kids, and I was thinking about how to get back into business. I really missed working. I missed building something. And the aha moment that I had was like, oh, I could build something for myself. I've helped other people build lots of big businesses and great returns and what have you. And then I thought I really want to get back to my entrepreneurial roots. I really loved building businesses, building my own things, and I was at a time in my life where I had this ability to bring all this together. And so it gave me a chance to apply everything I'd learned in private equity. There was really nothing different about how to invest in real estate, as the exception of like understanding what a cap rate is or something specific to real estate. But it's the same principles. You're investing, how you're doing your due diligence, how you're interviewing and meeting your operating partners. What are the standards that you're setting for expectations? What are the fees you're charging? All that stuff. And coming at it from an institutional practice meant it was, pretty robust and pretty high caliber. So all I did was one day I just woke up and said, oh, I'm going to apply all this into building my business. So I did spend a year or two kind of putting in place what my strategy was going to be, who I was going to partner with before I ever stroked a check or found a deal. For me, it was important to put the back office in place, so to speak, before I started taking capital from people.
100%. And I think about some of my friends who are in private equity, and I've talked to them about how they structure deals and, how do they look at things and how do they think about it from a process standpoint. And it
Mhm.
seems as though there's almost a little bit of a different way of thinking about things between real estate and private equity. For example, leverage. They like very low leverage deals.
Mm,
And a lot of real estate investing is 70, 80% leveraged. So
sure.
how do you look at that as someone who's coming from private equity and now going into real estate? How does that compute for you?
Well, you need leverage on real estate, right? It helps you. You got to get mortgages, and you got to fund it somehow. You can't raise 100% equity in a real estate deal. And by the way, leverage is a good thing in real estate. It helps you achieve some returns that you couldn't get just on equity alone. In order to take down large transactions, you need some leverage, and minimum would be about 70%. We sort of stick in the sort of 70 to 85%, depending on the deal. And it's helpful, right? If you are pragmatic about how you undertake the debt or the financing contribution, and you really analyze your numbers in the most conservative way possible, and it still makes sense, then leverage, of course, is your friend.
And I think one large part of what affects whether leverage is accretive or destructive to your business plan is the market that you're investing in. Would you tell me a little bit about Texas? Why Texas, right? How'd you choose Texas multifamily in particular? What opportunities do you see there? Where do you see yourselves in your business filling the gaps in the market, if there are any?
Hmm. Well, as a Canadian investing in the US, I looked in my own backyard. There's deals here and there, but for us, it just made a lot of sense when you look at the economics. So Texas is a very business friendly state. They have, for instance, no sales tax. It's just a state that is in business for business. They have very landlord friendly tax or laws rather. They're the economics are incredible. People are continuing to move there, so the growth in population continues. The growth in head offices moving there. One stat that I love to throw out there, it's kind of funny but it's meaningful, is the U-Haul report. I think we've talked about this before, AJ, where U-Haul, the moving company, has its growth index, and the last 6 out of 8 years, U-Haul one-way rentals number one state has been Texas. which means people are moving. People move for jobs, right? And all the head offices are moving to tech. All significant number of head offices are moving to Texas. Amazon just put in a huge hub. Tesla's there. I mean, just like you name it. In addition to the oil and gas and all the other industries, hospitality has become a huge industry there. And people, like I said, move for jobs. The jobs are great. They're paying them well. It's a relatively low cost of living, but to our benefit, it's still very much a rental mentality there. It's still a bit prohibitive to buy a home there. I think the last time I checked, the average home to purchase was about, I'm going to say about 275,000. And that's still a high barrier for a lot of people. And because they tend to move around a lot, they are more likely to be renters than long-term homeowners for the most part, for what we see. So the kind of multifamily we like is sort of value add or core plus, sort of up on the nicer side. It's an A class or B class building. And, they like a few of their amenities, and it has to be as comfortable as possible. But it's very much a renter state. So there's a whole lot of reasons to invest in Texas. We just love it there.
Yeah, we have some stuff in Texas too, and even the homes in some of these markets where interest rates are, they've increased substantially in the past few years. Homes are still flying off the market, which is wild to think about.
True. And when you put that in the context of hearing from a Canadian investor, like I live in Toronto, the average home price here is to buy a house in downtown Toronto or the core, it's at least $1 million, $1.5 million. So when I hear 275,000 or 300,000, that seems like a steal for us, but it's a robust market. And the important thing though, AJ, you're probably seeing this too, is that the supply is not coming on anymore, right? The housing starts have slowed down. Even building for new rentals has slowed down. So, that just bodes well for investing. When you look at all those metrics together for your strategy and for mine, it's a great time to invest in Texas.
So you've alluded to this a few times, right? You're a Canadian that's investing in the United States. What are some of the unique challenges and advantages maybe that you've encountered so far?
Well, I say this somewhat tongue in cheek. So for instance, on this current deal that we have, we're raising $5.25 million on the equity side. If you wanted to take that kind of capital, invest in Toronto, you might get 2 condos and a couple parking spots. In Texas, with $5 million in equity, I can buy 120 units and, all the parking I could ever need, because we invest outside of primary markets. So we're in secondary and potentially tertiary markets. So I say that half tongue in cheek, but it's just the affordability is incredible on the deal side. If you can get them at a discount. So this particular deal, we're buying it at a $3 million discount to replacement value. So there's equity on the buy. A cash flow is because the occupancy is high on one of the buildings. The other one needs to lease up a bit more. They're newer buildings, but it's just the economics just work a lot better. And then to answer your second part about the Canadians. So number one issue people have about investing right now from Canada into the US, and we predominantly raise most of our capital in the US because Canadians are a little bit more gun shy, and there's a couple other considerations. So one question we always get is on the FX. And the way I answer that, and it's a deeper conversation, but you take your hit on one way and it benefits you on the way back when you repatriate.
Real quick, would you define what FX is for our audience?
The foreign currency exposure. So if you're buying it in the Canadian dollar, and what is I don't even know what's trading at today. It's like $1.40 or something. So it's a bit of it's a hit for us. It's $1. We have to pay $1.40 for every $1 invested in the US. So, but that's on the outbound. On the inbound, that benefits you because the FX is still in your favor to repatriate the capital back to Canada. So, and then I think the bigger issue that Canadians have is the tax treatment. Like, what do you do? Like, I don't want to pay taxes in the US and in Canada. And the appropriate or the proper way for a Canadian to invest in the US is through a GPLP structure, because a GP will have set up an appropriate LLC structure, so you're not double taxed. There's this issue around double taxation where you're paying tax in the US and tax in Canada. And what the IRS, the GP will do for you with the W-8-BEN, they'll register you, you'll get a tax credit, and then you'll take that credit and file it with the CRA in Canada. So you're not double taxed. We unfortunately can't get around capital gains the way you guys can in the States. And we certainly don't have that lovely thing called accelerated depreciation or anything like that. We can't even do a 1031 exchange up here. Like we just have But there's so many great ways to take advantage of great deal flow in the US that way. So, and so many more ways to invest. If you're an investor, your self-directed IRA or a 1031 exchange, there's lots of ways you can invest in the US that we just don't have access to in Canada.
And I think that's something that US investors may not understand. They may not understand the opportunity that they have with a self-directed IRA, with 1031 exchanges, with accelerated depreciation that other countries just do not provide. Even leverage. Some of
Yeah.
these other countries, let's say South America, for instance, it's pretty difficult to get leverage in some of these countries. And so with it being widely available in the United States and with us having strong lending institutions that can back that, it's a major advantage.
Yeah, absolutely. Yeah.
So how do you approach building trust with investors? Especially Texas is very competitive, right? There's a lot of people doing business in Texas. How do
Mhm.
you build trust with investors in a competitive landscape like that?
I think you just have to be prepared for a long nurture cycle, right? Like there's a lot of new investors into the space. Very few people come to the space with a huge database of investors ready to go. And right now today, it's an even more challenging environment to raise capital. Investors are a little bit gun shy right now, waiting to see what's going to happen with the current administration, with the tariffs, with interest rates. There's a lot of reasons why people are sitting on the sidelines and holding on to their cash. But I think that now, if anything, is a buying opportunity because you're seeing a lot of opportunities sitting on the shelves. The banks have taken back a lot of properties. There are a lot of distressed sellers, maybe not the delta we thought we were going to see, but still really good opportunities. And I could fund probably 10 opportunities right now if I could find the cash. So going to market, trying to raise capital you just need to be prepared for a long cycle. So a brand new investor could take 8, 9, 10 months to close. Unlike the institutional side, when it was, okay, so-and-so pension fund, what's your allocation? Because you're just filling a bucket. I mean, it had to be the right deal, obviously, but it was more of an allocation thing as opposed to I need to train you and teach you why you should care about this, an LBO or something, large buyout. Smaller investors, it's their personal capital, which is actually what I love most about this business because it's so tangible. When I was managing billions of dollars, I was in my late 20s. I wasn't even thinking about my own retirement back then. Now I'm really focused, 30 years later, I'm really focused on my retirement. What have I put in place for myself? What's the wealth I'm generating? What's the legacy I'm leaving for my kids? And it's so much more tangible now that I genuinely want to help people realize that this is a really good way to augment what your retirement plan should be. It's just one of the best. Real estate is number one by far my favorite way to invest in your future. So now I get to teach people about how this will impact your retirement fund. And, if you just put all your money in the S&P, the 40-year return average is 11.8%. You're never going to retire on that. It's not going to build you enough wealth. But if you can get a couple of real estate deals in at 20, 30% IRR, now we're talking, and now we're really building wealth, right? So you just have to be prepared for a long education. And as you can probably tell, I could chit chat all day long. I love the education process. And I spend a lot of time teaching people why they should care. And when you do that, you get the chance to build a relationship, and a relationship builds the confidence, builds the trust, and then the trust hopefully turns into a client.
Yeah. One thing that you mentioned earlier, right? The IRR, high mid 20s or low 20s IRR that's just extremely above what anyone has seen in just regular, the stock market or whatever they might invest in. You may have a couple odd years where you have that and then it bounces around and does that and whatnot. But my question was going to be, the biggest thing with IRR is essentially selling the property, that you get a big boost in cash back to you, or maybe a refinance, big boost in cash, but then you get your capital back and then you got to do another deal. So how would you say for these people when they're funding their retirement, how would you, I guess maybe not advise them on what to do, but what would you say to that, right? At that point, essentially you're increasing your cash, but then you got to go find another deal and another deal and another deal. What would you, or what have you seen people do so far to just keep that going?
Well, it depends on where they are in the life cycle of their retirement. If they need the cash and that's what they're going to cash out completely, and that's what they're going to move to Mexico and spend their last few years as a retired couple doing, crafts on the beach kind of thing, then cash out, do that. But and I'm not a financial advisor, so let's put that disclaimer out there right away. But I was an LP before I became a GP. I have LP, like I have deals that I've done where I'm, starting to collect cash, and someone called it a laddering effect once. And I thought that actually gave a good visual. So you invest in this deal, GP1, and it starts paying out in year 3. Then you do the next deal. This one starts paying out in year 5. And then you do this deal, or even 3, 4, 5. So you can ladder your returns. You only have to do a handful of those things, like 4 or 5 we're talking about. Of course, you have to do your due diligence. You have to figure out who those operators are, and if they've returned capital historically, or if they're brand new as a team, like which we were. You got to take a rider, and hopefully that these guys are going to perform. And once they do, I'm a big believer in investing in multiple generations with a GP, because if they've proven themselves, they've proven their thesis, they're sticking to their strategy, I don't need to go investigate 10 more new GPs. If these guys are putting up the returns that they say they are, they're communicating the way I like to be communicated with, the cash flow is coming, the distribution's coming, and the refi is happening. They're exercising their strategy and it's working. So I think you need to continuously keep that relationship going as a GP. And as an investor, I would say find your 2 or 3 GPs and keep the money going. Like I think the worst thing you can do is cash out. Everyone makes their own choice. I think the worst thing you can do with real estate is cash out too early, because we were talking offline earlier. The appreciation in real estate continues to perform unlike any other asset class. There's ups and downs. Every market does this, but if you look at the trend lines for real estate, it's like this. I don't know if I'm doing this the right direction. I'm trying to do it for your direction, like this, and it comes down a bit, and then it goes like this. I just love real estate personally as an asset class to invest in. I think it's, it pays you 2 ways. You have distributions on the front end and capital appreciation on the back end. So.
And let's say too, the market goes down. The market doesn't always go up. It doesn't always go up and to the right. But let's say the market goes down. Like you said, one of the biggest mistakes people can make is cashing out too early and selling now when the property is either below pro forma or below, a certain point where maybe they're losing some money. It may make more sense to just hold on to it for another 5-10 years until the market comes back. You're paying down your debt. You're continuing to improve the operations of the property. And after 5-10 years, it's going to be worth a little bit more. You do have that ability then to stretch that out and sell when the time is right, if you're buying it correctly and if you're buying cash flowing properties, which you guys do core plus value add multifamily. So that's something that,
that's typically cash flowing properties. Listen, if a buyer comes along and says, I'm going to give you this gigantic price for this asset, everything's for sale. Real estate 101, everything's for sale. You don't fall in love with the property. If you've made a substantial return, sure, fine. But those opportunities are few and far between, right? No one's going to give you this like crazy, maybe they do, but I've never seen it happen myself. But, slow and steady wins the race, I think, with real estate. And if you can manage to keep your capital invested, your returns are potentially up and to the right all the time.
So beyond real estate, other asset classes that you invest in, and if so, how do you balance those?
Me personally?
You personally, as either an LP or just an investor?
Yeah. So as an investor, so I have done, like I said, I'm an LP in a handful of partnerships. That's my real estate chunk. We also have a couple of real estate properties that we own as well. And we do have money in the stock market for sure. You want sort of that short term. I think I like how real estate is non-correlated to the stock market. So I want, a little bit of juice from each. So, and the stock market has performed, fairly well in the last couple of years. So it's nothing to sneeze at. Like a good 10% is a good return. It's not amazing. So our exposure to the stock market is, 30-40%, and our real estate's up here. So I just think personally it's been a formula that's worked really, really well for us.
Nice. And can you share your approach to structuring deals that align the interests between GPs and LPs? How do you structure those?
Yeah. So first thing is looking at the fee structure any GP would charge. What's your waterfall? What's your fees? Making sure that those are aligned with their standards, a standard waterfall, a standard fee that's acceptable, maybe acquisition fee or a refinancing fee or something. Those are standard within a range. If you start seeing GPs asking for bigger fees because they've performed well on a past deal, I think they can now start charging greater fees. I'd kind of question that. But yeah, I think it's number one. It's like, how does the operator, the GP, undertake the due diligence? How are they assessing the deal? Dig into the assumptions. Always dig into the assumptions. I really, I tell my LPs, like, ask me the questions you need to ask me, which are, what assumption are you making on this aspect? We take them through the underwriting to the degree that they want to go through it, and it's always open to anybody. And I think instead of having to understand the numbers, if they understand our thought process, that's way more important. So if we're coming in at, here's our worst case, best case, and here's where we think where it's going to make sense. And if it doesn't make sense on two of those three metrics, we don't do the deal. So I think if it's better for LPs who are numbers averse, let's say they're allergic to numbers, if they understand our methodology and our approach, that is as meaningful as to those folks that want to really dig into the underwriting. We have folks that are like that too.
Right. Because you're going to have people who are, maybe they're like artists, right? You may have someone who's an actor, or maybe they're a musician, or there's someone that's not really numbers oriented. They're more on the creative side, and that's where they like to spend their time. And then you're going to have people who are very much, left brained, and they love to focus on and digging into the underwriting. I love that you walk through the underwriting to the extent that they want to go through it. I love that that's available to people. And also, it's something super interesting. I found some people don't do that. Have you seen that?
Lots of
Having
times.
the underwriting available?
Yeah. Having grown up in a super creative family, I never thought I'd ever even understand any of this stuff, let alone work in it. So I get that there are people who come at this with just, I don't understand a single thing you're saying. Don't take me through numbers. I don't like math. And so I understand how to approach those people, how to talk to those people, as well as, on the number side. I mean, doing this for 26 years now, actually, there's an approach for each person, typically the two buckets. And I can speak to both, which has been a little bit of the experience I've gained, but also the family I grew up in. And interestingly enough, my one metric on finance was from my mom. My mother was the CFO of our family business. It was my parents were art dealers for many, many years, 40 years. And my mom was the CFO of the business. And she marched, I have a twin sister. I think I've told you this story before. She took my twin sister and I down to the bank when we were 8 years old. And we opened up a checking account, and we had to deposit she wrote a check to us every Saturday for our allowance. I'm going to tell you what it was. It was $1 back then. And $1 got you a lot of candy, but we were not allowed to spend it all. We had to balance the checkbook. We had to deposit the check. We had to balance the checkbook. We got to withdraw 25 cents to spend on whatever. It was crazy. And so like that foundational thing, I had no idea that was so important and foundational, that I understood that. And it gave me confidence in other areas of math or finance, whatever, that I just wouldn't have had, I don't think, growing up in an artistic family. So I actually, during COVID, I was president as a not-for-profit for 2.5 years. And it was focused on contemporary arts and it's a funding organization. We put out easily $500,000 a year for sort of middle career artists, not beginners necessarily, and certainly not established, but there was this middle market of mid-career artists who were struggling to get really good acknowledgement, or just jumping the next stage. And I thought, being a finance person, oh, well, I better teach them Finance 101. I wrote this whole program about how, because it was COVID, like they're all losing their studios. They can't pay their rent because they're not selling any art. Of course, they're going to want to learn finance. And guess how many people signed up for my program? And I put a lot of blood, sweat, and tears. This was before ChatGPT. I had no help on this. I created this whole thing. Guess how many signed up for it?
2?
0. You cannot teach people something they don't want to learn or are too intimidated to learn. So I try to demystify as I work on the real estate side. I get that people come at numbers totally differently. It's the one thing that people have the thing stuck in their head that they either can do or can't do. And I have 2 kids. I have one of each, right? So it's just make it simple, demystify it, and it serves people, right? So first and foremost, any GP needs to be out there serving people, educating people. And that builds, like I said earlier, it builds the confidence, and then it builds the trust, and then it potentially becomes a client. So there's no way around it.
So demystify for us LPs and their, evaluation of potential real estate deals. You've been an LP, you've been in those shoes, you've done it multiple times. You've also been a GP. So you understand from the GP side, how underwriting can be changed to make a deal look better if it's not
Yes.
actually that good. So what
Yeah.
are some of the things that LPs should be looking out for when they're evaluating potential real estate investments?
That's a really good question. And we're going to really get into the weeds if we take a lot of time on this. And I don't want to, I'm going to get myself in trouble here with other GPs, but the reality is you need to be upfront and honest about the numbers you're using, because you can put in, like in real estate, there's a cap rate. And if you put in an incorrect cap rate or something that's more favorable, you can make your deal look amazing. And the LP won't know to say, like, what's a cap rate? And I'm like, we're just going to assume that that's okay. But if they have that, oh, well, maybe I should look into what a cap rate is. And then they realize that cap rates are actually more regional than not. Or is it the right cap rate for that space and that market? Then you start digging in. And I think we saw this the last couple of years where cap rates were crazy and people were funding these deals at crazy numbers. Part of the reason why I didn't get involved, and I'm no genius at this, trust me, but I just couldn't make sense of it at some of these numbers. So I was more comfortable sitting out watching what was going to happen to the market. My partners and I, we all did. And I think it's just knowing some of those little nuancy things. And I put together like a checklist for our LPs, whether they do our deal or not. Here's a checklist of like 50 things to ask your GP as you undertake your due diligence. And then, dig into any of those elements that you're not familiar with or something. Like LPs have every opportunity and every permission to ask whatever question they can. If the GP doesn't want to answer it, then that's your answer. I wouldn't necessarily proceed with that deal if they want to, if everything's behind the wall and, that's our secret sauce, we can't share that with you. Well, you're taking someone's money. You owe them exposure to what we're going to do with your money, right? So,
not only that, there's not really any secret sauce when it comes to value add multifamily. Maybe you disagree, but there's a lot of people doing it, and there's only a certain number of ways to do it. I don't know what you think.
Yeah, 100%. But I find a lot of GPs kind of hold back their information and just say, like, just trust us. We're doing a good deal. And I would just encourage LPs to ask as many questions and not feel intimidated, and just make sure that they understand we're a fiduciary of your capital. We have to perform in a certain way. So, and to your point, there's no magic. Like, we're actually not looking for magic bullets. We're looking for a repeatable, verifiable, honest process that is going to return year over year. And by the way, we're going to do exactly what we said we were going to do. A lot of GPs kind of went off the rails a little bit. And I've seen this in my entire career. You're investing in what you think is a middle market buyout fund. When I was in PE, and suddenly they're starting to creep up that price tag, and they're suddenly doing some LBOs because they need to deploy the capital because they're running out of time to deploy the capital. Well, you're a little bit offside there. People don't realize, this is the other thing LPs need to look at too, is when you're like a GP LP fund, typically, let's say 5-year fund, there's a period of time to deploy the capital. Then there's the period of time where you need to do your refi or whatever operational improvements. And then there's the period of time on the back end of the fund where you have your exit, either year 4, year 5, typically. And if you're not going to exit the deal, which is to say you're not going to sell the property, the LPs have an opportunity to exit, right? So if you're not going to sell the property, like, they need to understand what happens in each segment of the time horizon. And a lot of LPs don't realize that. And a lot of GPs haven't necessarily, when they raise a fund, haven't necessarily deployed all the capital that they need to deploy persistent or consistent with their strategy. And then that's when they start kind of going offside. So, and LPs should call them on that.
Yep. Great point. When you're looking at strategies or deals that are consistent with whatever your strategy is, how do you conduct the due diligence to make sure that aligns with both your investors' goals, but also your overall strategy, which hopefully those are one and the same?
One and the same. So your question is, how do I conduct my due diligence?
Correct.
Well, first things first, you get the deal deck, whether it's off market or from a broker. You put together something if it's off market. You really dig into those numbers. You get the rent rolls. You get all the financials that you possibly can. Perfect, important, but doesn't tell the truth necessarily. You need to dig into those numbers. And then I think number one thing you need to do is go to the property and walk every single unit. And just, we have a checklist again. I take video, I take pictures. We go through every single unit, take note of the carpets need to be changed, or painting, or HVAC issues. You literally need to go through it sounds so tedious, and it is, but you can get it done in a day or so. And then you have a record what the condition of the actual building is, as opposed everything looks better on paper, or it's promoted to look a certain way. And you are often surprised when you go on. I'm sure you see this too, AJ. When you go on site, you're like, whoa, this doesn't look like the picture. So I would say, first and foremost, if your GP isn't walking the property, that's a red flag. If it's within the budget, you should actually invite your investors down to walk the property once you've, transacted the deal and you're further along in the continuum. Bring your investors down so they get the experience of walking the property and understand what the important metrics are. Like, you have to meet the property manager. You have to understand what the occupancy truly is. Are there a bunch of beds on the floor where they've put a bunch of homeless people in there to make it look like the occupancy is high? We've seen that too. There's lots of tricks that sellers can do, and you just need to be able to push back and dig through the actual real details.
Yeah, one really interesting detail that you can find as well is, especially if you're buying properties that are either vacant, or maybe they're a little bit older properties, just calling the city and asking the city, hey, what's going on with these? Do you have any inspection reports, anything that's deficient? You may find stuff that's either structurally deficient, or they have certain things that have been marked by the city that's moving this property closer to condemnation that may not be shared by the sell side. So doing all of diligence beforehand is huge.
Another thing that we do too, historical weather events. So if there's been a big hailstorm, for instance, and the property manager doesn't have to divulge that there's been a big hail incident, but it's going to affect your roofing in a couple years. Like, if you actually go back in time and pull down those weather events, you can actually at least speak to it and say, like, I know I'm going to have to replace this roof in 2 years. It's supposed to be 10 years. That's a bit of a negotiation play, right? So it gives you a little bit of power. So there's so many interesting little tricks like that, AJ. You're right that you can pull down some good information that way, for sure.
So what KPIs do you prioritize, key performance indicators, when you're assessing investments, either while you're operating them or while you're on the acquisition side?
There's some good ones. We like the cash return. A lot of it comes down to, like, what's your relationship with your property manager? Like, is it someone who came along with the property and therefore has maybe a different loyalty? They're not completely loyal to you, or did you bring in a new property manager? Because then that changes the nature of that, and you get down to the KPIs that are really important for you. There's a whole host of them. Top of my head, I can't think of anything right now, but there are important ones, like cash on cash return would be one that comes to mind. So, but again, it's really the boots on the ground, property management, and the rent rolls and things like that. Just making sure that the numbers are coming through, and is occupancy popping up the way you expect it to be popping up. Lots of little things like that, but it's important that, like, you're on that and sticking to it, and your property manager has to be your partner on this.
100%. Yeah. In making them your partner, do you have any sort of incentive structure or any way that you structure the management agreement, anything like that? How do you manage that property manager and approach that asset management side?
So we always look at what other properties they manage, because we don't have our own property management company. A lot of GPs eventually move to that, or I shouldn't say a lot, but a number of them do move to that. So that sort of built-in employee structure with bonuses is a way to do that. For us, we interview new property managers unless we have one in that particular jurisdiction. And we look at historically what they've done. We sort of tear apart, what was their marketing approach? What was their follow-up? Who are they bringing in? How are they vetting that person? What's the software that they use to vet the people? Lots of different things you need to do, because property managers, vary in their ability, let's say, and you need to pay up for the good ones. So you're paying a healthy 10% versus 5%. I'd be wary of somebody coming to me saying, I'll do this for 5%. Like, what are you going to get for 5%? So what are you finding? What do you find is working these days? I'm always curious how other people do it too.
Yeah. And is that 5% plus payroll? Is that just 5%? Sometimes the fees are hidden, and hopefully the payroll's up front, especially depending on the size of the property. If you have a smaller property, you're probably not paying payroll. you're probably just doing a property management fee if it's a
Correct.
3-unit or a 4-unit. But if
Yeah.
you're now looking at a 50 or a 75, you better bet that there's going to be some sort of payroll there, because you're
Yeah.
going to have someone, whether it's maintenance or like a part-time property manager or a full-time property manager, that needs to be on site.
100%. And for us, like this current deal is 120 units. That's property management plus maintenance. You cannot manage a property that size without maintenance. And is that a part-time maintenance? Is that full-time? This particular portfolio, there's 2 buildings that are within a half a mile of each other. So we can actually share the efficiencies that way. So we'll have a property manager on that building. So it makes it a bit more affordable.
Nice. Let's talk social media, because your Instagram, significant traction. I don't remember how many followers you have. Is it like 20,000?
It's just under 28 now.
Yeah, just awesome. And how long have you had that for?
Actually, about a year now. So I started it, I think June 1st last year. And then it was crazy to me, AJ. Like by the beginning of July 1st was Canada Day. I had my first viral video. It was like 2.7 million views or something. It was crazy to me.
What was the topic?
So that my Instagram is my personal advice to younger generations or people that aren't comfortable with finance or have no idea how to think about their financial future. They don't understand any financial literacy. They know that they need it, but they don't know where to start. So that's my passion project. I spend time teaching people in the IG way, which is like 3 things rich people would never do with their money kind of thing. And it's bite-size, interesting, informative advice from your auntie kind of thing, where it's like, here's some common sense stuff. And first things first, and I said this at the beginning, first things first, have a starting point. Just start, right? It doesn't start by itself. You just have to make a commitment to yourself that you want to figure this out. And by the way, like I said, it's not a mystery. I break it down. I have tons of courses and like freebie stuff that I just give away. Here, start this. And it's interesting. So the pension fund I used to work for, and another pension fund actually approached me recently to go in and teach their Gen Zs, not finance 101, because it's, I can't teach finance to these folks, but it's kind of like common sense advice, like what's a savings account, how to get out of debt, how to know what's good debt and bad debt, what do I need for my retirement, and how can I get there. It's all the basic stuff that's never taught in schools. I still think this is a huge loss for schools, that they could be teaching this in a much more robust way to our kids. What's a mortgage, how do I buy a house, how do I write a check? No one writes checks anymore, but you know what I mean? It's just like, how much should I have in a savings account? What's an emergency fund? It's all the basic stuff that if you learn this when you're 20 and you start putting away a little bit of money into an investment account, this magical thing called compound interest will be your best friend by the time you're retired. And the number one issue you have when it's younger people, I advise like women who are newly divorced, for instance, who've never managed the family finances and they're starting from scratch. And their number one thing is like, how am I going to put food on the table for my kids? Like they just need to know how to budget or something. But I teach lots of different people in lots of different areas. But the number one thing I'm trying to get across to 20-year-olds is to really genuinely think about your retirement. It seems so far away. No one cares about it. I didn't care about it in my 20s. I really want to change that mindset. Like you need to care about it. And interestingly enough, like Gen Zs are a lot more embracing of understanding, like they care about social issues. They care about what world they're inheriting. And they care about their retirement way more than previous generations. It's astonishing to me. But they are also struggling with lifestyle creep and the influence of social media, where everyone looks like they're having this fabulous life. And one of the number one questions I get is, how do you balance lifestyle with, prudent investing or thinking about your future? Do I have to give up everything? Can I have zero fun in my 20s? Am I allowed to have fun? I'm like, well, you can have fun, but I just wouldn't do $90 brunches every day.
No fun.
You're still in that age group where you have to have fun. Of course you have to have fun, but I always say, do a set and forget, right? Just the second your paycheck hits your bank, already a percentage goes out to your investment fund and you don't even think about it. So you're just dealing with whatever's left over and you get all your expenses paid that way. So life has to be a balance because you don't know how much time you have. I don't recommend just being a save and wait for retirement because that's never a good plan. You have to have a balance in your life for sure. Life's too fun. Life's too short. There's just too much to see in this world, too much to do. I don't want anyone to ever feel like they're missing out. I want them to feel like they're doing just enough, and to set that in their brain that this is enough. It's not, I don't have to do this. I just need to do this. And it actually makes me happy. Because what makes me sad is like all these kids walking around like they think they have to have the best watch and the best car and the best bag, and they better have great, Instagrammable moments on their trip. And then they're just getting in heavy debt. And there's a huge number of Gen Zs are declaring bankruptcy. Over like 53% of Gen Zs are declaring bankruptcy in their 20s. Is that astonishing? Like, do you understand the ramifications of declaring bankruptcy in your 20s? It just sets you back so far from, maybe you want to buy a house. I mean, maybe you have a big purchase in your future. Well, you don't qualify for a mortgage that way then. Like, it's, your credit rating matters, right? Things matter like this. So I'm just trying to do like a bit of financial common sense, and because it's, by the way, extremely wrapped in mental health, right? So, and I care deeply, deeply about this issue. And if you are stressed out on the finances, your mental health really suffers. And what, we could go down that rabbit hole. May is Mental Health Awareness Month, and I just think it's such an important thing to talk about. And I love that Gen Zs are so open about talking about it. Unlike my generation, nobody would ever admit to being stressed, let alone having a mental health issue. So I love how open people are, and millennials too, talk about it. I think if you talk about it, it becomes solvable.
Yeah, it gives you an outlet. The other thing that you mentioned too is, right, enjoying the money, having some sort of enjoyment out. Because I watched a video, I think it was sometime in the past week or so, and it said there's like 3 or 4 things that you can do with money. You can spend it on stuff, you can spend it on time, you can spend it on experiences, and something else. I don't know. I don't remember. But the point is like, the stuff isn't really going to make you happy. The time is going to give you more time with loved ones. The experiences is going to give you memories. And so just accumulating stuff isn't really going to help you.
Wow.
It still helps to have money because you're going to be able to do the other things that actually make you happy, having time, having experiences.
Yeah.
But taking the emphasis and the focus away from, well, I need the most expensive car and the nicest clothes and the best handbag and the best vacations. I mean, the vacations are pretty cool, but like, you can do it on a budget still.
You can. And instead of doing 4 a year, you're going to have to do 1. I'm sorry. Like,
Right.
that's, you care about your financial future. Let's be realistic about what you can, like, you cannot go into debt for everything that you want to do. I 100% agree. And interestingly, I'm finding in my research, Deloitte just put out their big global financial wellness survey that they do every year for Gen Zs and millennials. And they're finding that Gen Zs in particular really care about experiences more than stuff. You're seeing a real backlash to really high priced designer bags, for instance. It's more about the experiences, because that's what, we're humans. Community, sense of community is one of the most important foundational things that we can experience in our life, right? There's a big epidemic of loneliness in, 20-year-old men, for instance, in the 20s. Like, if you can create a sense of community somehow, and community is achieved through experience, then we're dealing with that on a global basis. We're dealing with the mental health aspect of it. We're dealing with, the awareness of your financial literacy and how that's going to serve you into your future. It's just having I'm so happy to see this, actually, because the stuff was just such a huge accumulation of junk. I personally have fallen prey to that. And I've spent the last 3 weekends clearing out rooms, donating stuff like crazy. My son's school does a massive garage sale every year. My garage is full of stuff. I just like, I'm in my, what is that? I don't know, like the paring it way back and just, living with less stuff. We just don't need stuff. But until you have that in your mind, people will feel like they're being left out of something, as opposed to you changing the mindset, going, no, I'm doing exactly what I need to do for me. So, and for the world, like, we just don't need all this extra stuff that we have.
It like clutters your mind too. When you got a bunch of stuff around you, you can't really think.
Yeah. And just think of the landfills, AJ, all stuff we're just creating. That's like, I don't want to, call out Timu or anything like that, but they're just like, there's just so much garbage being created now, and you have to replace it regularly. And like, are you actually benefiting if you have to buy the same thing 4 times because it's fallen apart, or buy it once as a good quality thing, right?
Yep.
Anyway, we could go off on a tangent about that. I feel very deeply about that.
Absolutely. And one other thing you mentioned, you feel pretty deeply about is mental health. So I just want to touch on it real quick. You've spoken about facing imposter syndrome before. How did you navigate it, and how did you overcome it?
Yeah, it's really, really interesting. I think about this a lot, and I teach this to young women a lot, to just, it sounds so simplistic, but it's not. It's presenting as brave till you actually feel brave, right? Till you actually own that. And one of the things I tell, and this happened very early on in my career. I was always like one or two women in a room. In capital markets, there were no women in oil and gas. In private equity, there were rarely women, maybe a few more than not. I was always one or two women. I took that as like, oh, this is my superpower because women think differently than men. And yes, there were many years where you're, patted on the head and, pushed to the corner and like you're not important enough. But I never looked at that as an issue. I looked at that as a challenge. Like, you come, you're prepared, you're confident, you know your stuff, you're leveling the playing field. And it's never been a challenge for me to walk into a room and go, okay, I know my stuff. I belong in this room. And young women and young people really, that's one of their biggest challenges is walking into a room and feeling like they belong there. So I always just say, pick one person, go say hi to one person, and it starts the conversation and it'll boost your confidence, right? And it's, don't go in completely blind and do some research, like figure out who the audience is going to be, or, if it's an event, what's the guest speaker going to talk about? Go up to a person and go, hey, have you ever seen this guy talk? Like there's little things that you can do that'll boost your confidence. It's amazing. These little wins add up to big wins.
Especially so, Gen Z, some of the younger audience, maybe even, some millennials and folks all across the spectrum now have access to ChatGPT. And that allows you to do research on some of these presenters and some of these
Yeah.
events that you're going to. So you have something to talk to the audience or talk to the presenters about, and you seem very educated about whatever topic it is that you're talking about. So doing that kind of research ahead of time allows you to have something going in where now you can put them in the driver's seat almost and ask them to speak to their expertise.
Yes, absolutely. I would encourage anyone going to an event, if you have the event agenda, pop it into ChatGPT and ask it to come out with like 3 scripts for you or 3 good questions to ask. You don't have to don't overthink it. Like it'll do it for you. It's amazing what it can do for you now and how well prepared you can be. And no one's expecting, by the way, no one's expecting a 25-year-old to know everything, right? Like I think you often go into a room as a younger person going, oh, if I'm not the smartest person in the room, I don't want to look stupid. Guess what? No one's expecting you to be the smartest person in the room. Everyone knows there's an experience curve and a learning curve. But if you go in prepared, you will wow, you'll knock everybody's socks off by just having done a little bit of homework. Everything in life is about preparation. And if you don't give yourself a moment to prepare, you're going to find yourself spinning your wheels like, well, why am I not getting opportunities? Or why is this not happening? It's all about preparation, right? Taking action, preparation. The rest is all the tedious follow-ups and to-dos. But if you take action by being prepared, you're setting yourself apart from your peer group.
Great takeaway. Arlett, thank you for sharing your journey, your insights. For listeners who want to learn more or connect with you, where can they find you online?
Sure. You can go to my website. I think you're going to put these in the show notes perhaps, but it's titanreico.com. And I'm also on LinkedIn. Please, anyone connect with me on LinkedIn. It's Arlett Tygesen on LinkedIn. And or you can find me on my personal Instagram. It's Arlett_Tygesen if you want the auntie's advice. Lots of different ways to get in touch with you, but please, anyone reach out. I'm happy to talk to you about anything.
Fantastic. We'll include those links in the show notes. And to our audience, thank you again for tuning into Capital Conversations. If you found value in this episode, please leave a like, leave a comment, leave a review. Until next time, keep investing in your future. I've been AJ Smith. This has been Arlett Tygesen, and we will see you guys next time. Take care.
Thanks, AJ.